Hi everybody, Steve Griffiths here, developer of the MTPredictor software program. In today's MTPredictor video, I'd like to take a look at how the US E-minis unfolded yesterday, which was Thursday the 17th of August. But as usual, let's start with our risk disclaimer. Remind you that all examples in these videos should be considered as hypothetical. No trades were actually taken. They're just shown for illustration and training purposes only. Remind you there's a risk of loss in trading and investing. Put another way, all professional traders know and understand, and more importantly accept, that losses can and do and will unfold. We've been looking at losses in our last couple of videos in quite a lot of detail, but just to remind you again that losses can and will and do unfold. All trade decisions your own sole responsibility. Right, let's have a look at some charts now. Just take that off. For you guys who've been following us quite regularly will know that the last video I did a few days ago talked about the hard side of trading. In other words, we looked at a day that was very difficult on the NQ and showed you that markets go through cycles and how some days the markets can be very, very frustrating. Well, today I want to follow up and show you the other side of the coin. As I said in the last video, because markets go through cycles, it's like a circle that goes round. So you have good times, bad times, hard times. So after some hard days, which we covered in the last video a few days ago, you should anticipate some good days, and that's exactly what unfolded yesterday. So I'd like to have a look at the ES in particular, and look at some sell trade setups we got here just before mid-morning on the 3-minute ES. You can see we had some history triangles here. The only reason they're history triangles is because there were basically 4 bars with double tops. So when there's a history triangle, it doesn't mean that it's a losing trade. What it means is that you can place the analysis on the chart. So let's go over this first red sell bar. Right mouse click to analysis. This places the analysis on the chart. So here you can see you're taking into a short trade, but never stopped out. You see it was a double top. So this trade here would have never been stopped out, and you'd have carried on down to the first target, where a profit of approximately 5.2R was available. Remember our correct position sizing. Here we vary the number of lots, contracts or shares to keep our initial risk small and under control, in this case less than 2% of a sample $20,000 account. Our MTP trend was red, so this was in the direction of the trend, so it was a very, very good trade indeed. Profit of 5.2R was very good, and as you can see is a lot greater than the initial risk of just 1R required to take the trade. This DP buy setup later in the day was against our MTP trend, so would have been ignored. So that was a good day. But for the more experienced users among you, was there any way you could have captured the continued decline? Well, let's go to the higher time frame chart. This is what we always do. The higher time frame chart is a chart between 3 and 5 time frames higher. So if you're trading the 3-minute chart, the higher time frame would be the 15-minute. If you're trading, say, a 15-minute Forex, the higher time frame would be hourly. If you're trading, say, daily charts like stocks, the higher time frame would be weekly. So let's place our DPs on the chart. The last DP, well, if we go back to our last pivot low in and around here, this would be our last support zone. We had that on our chart as the market opened. Now, can you see what happened before we got our sell set up, which was just before or in around 11 o'clock here? What had happened is the market had gone down below this support zone, made 4 consecutive closes below the zone. In other words, it had confirmed that this zone had indeed been breached, and the decision, this is why we call them decision points, on this particular DP was for the market to carry on down. In other words, for the trend to continue. Our normal guideline is 2 consecutive closes beyond a DP level means the trend is going to continue past that level. So where would the next support zone be? Well, if we zoom out, the next pivot lows are back here somewhere. Can you see that? Right back here. So let's place a DP off this low. Let's place a DP off this low. And as you can see, they're broadly in the same area. These two DPs are broadly in the same area. So let's just take this one off and let's stick with this one. So the idea being is that as the market has gone down through and breached this first DP support zone, the next support is not the way down until down here. And you can see that's what the market did. It carried on down. So if you're on a 3-minute chart, The question being is, why would you want to come out at this first target here? I mean, the 5.2R was a nice profit, when the next support zone is not till a long way below. So you had a choice here. You could either choose to trail with your ATR stop, which is our red dots. If you had been, you'd have been just taken out here, but your profit would have been increased to nearer 7R. Or you could have decided that actually I'm not going to do anything until you get right down to this lower DP support zone. Remember, this would have been on the chart in advance. You knew about this support zone before the market even got there. And if you had have come right the way down here, your profit would have been up to just over 16R, which is an absolutely massive trade. These are the kind of trades you really need to capture, because they are the big profits that basically put your bank account well in advance. Were there any other indications or anything else to be aware of? We tend to sometimes look at our high-low close, where we look at our ATR range. So your ATR range would have been here. So you would have actually been beyond this. So this might have said to you, well, actually, I want to be a little cautious because we might not get a continued trend, because the average move is only into that daily ATR. But because it's an average, you will get 2-3R days unfold every once in a while. And that's what this did. So if you were at all worried about this, the way to get around this is use our 100% initial risk level. Remember, this is what we teach, is that you only tend to use the 100% initial risk level when there's something that you're worried about, or there's something that you think you want to be slightly more cautious about. So with this, because of the large degree trend, the DPs, the large degree trend looked to be down, and it looked to be down with a potential big move into this next support zone. So using the 100% initial risk level, once you got down to this level here, you'll bring your stop to break even, and that then allowed you to carry on down right into this low here. So that would have been a very, very good trade indeed. Just take that off. So these are the kind of trade setups you need to capture with MTPredictor, and it's the ones you need to be ready for, and it's why I covered this in the last video I did and talked about the cyclical nature of trading. It's so important to understand that markets go in cycles. This is why we talk about it so much. It's so important to understand after a few hard days, a few days where the market has been chopping sideways and going nowhere. After a few days like that, you should anticipate a big move. In other words, the market is sort of coiled up and ready to spring out. If we now go to the 24-hour chart, let's have a look at an hourly chart, and here it's a little bit more obvious. See, here the market has been chopping sideways for a few days like this on the hourly chart, so it's ready to make a big move. This is what happens with markets. They don't make the same move every day. They coil up, they spring out, they contract, they expand. So on this 60-minute 24 session chart, again, here's the DP from the last low. You can see you've gone beyond that. The next support zone was right the way down here. Yet again, you should be anticipating a big move. If we look at the daily chart, again, everything was saying that after a couple of days chopping sideways like that, you see that 2 very narrow range days, you should anticipate you're going to have a big day as the market expands. So these are the kind of things you need to be wary of when you're trading. It's why I do these videos, to explain and try and teach you how markets unfold, and why we don't use MTPredictor as a black box system. Black box systems can't take account of this. This is why you need to understand how markets unfold, understand that they go through cycles, and understand that after you've had a couple of hard days, which again we talked about in the last video, it's important to talk about the hard days and days where markets really don't go anywhere, and the days that are very frustrating, to then be anticipating that after that you could get a big move day like this. And the important thing is to be able to capture big profits like this when they unfold. And as you can see, that's exactly what MTPredictor did with our TS3 sell there. After we'd breached our 15-minute support, the next 15-minute support was way down here. If you'd look to trade down into that next 15-minute support zone, there was a potential profit that was almost, well, over 16 times the initial risk. So these are the kind of trades that you need to be capturing, and they're the ones that can be found with MTPredictor.